Hello YouTube, it's the Cowboy here. We are on Elliott Wave Cafe, so welcome. And I will start a new series today that's going to be called Macro Cafe, and we'll take a look every couple of weeks. So just like I do on Bitcoin and Ethereum technical analysis every 2 weeks. So every alternate week I'll do an episode on some of the macro things that I see in terms of technicals. So we're going to do oil, we're going to do gold, we're going to do the 10-year yields, we're going to do the S&P 500, and we're going to do the DXY, the dollar. So we'll take a look at these technicals and kind of see how the market progresses. We'll start with some longer time frames and then maybe drill down to some smaller ones and see how we can take advantage of this and kind of how they relate to each other. I'm not going to go a lot in the fundamentals. I'll stick with the technicals and the Elliott wave structures. So looking at the chart of oil here, we have a 2-week chart, and we had a big corrective pattern that started back in 2008, and you've had a nice 3-wave decline in here, what we consider a wave W. So it's the first zigzag of a double zigzag, and we've corrected here in 3 waves in a wave X, and then since then, and this was back in 2018 in the fall, we've done a large 3-wave decline, with the latest one being back in the March of this year when oil went actually below zero level. Now these charts don't show that. They show them kind of going all the way back here to 10, but it doesn't really matter. We're considering this a completed sequence in a W, and then you had your X, and then you had your sharp drop in Y. And if this is the beginning of a larger, so if I go to a monthly chart, if this is the beginning of a larger uptrend in oil, remains to be seen, but this move here is clearly corrective as an overall structure. So going from a 2-week to back to a 1-week chart, the first rise here of this lows, we're considering this as being a wave A or a wave 1, and the subsequent decline was a B wave or a wave 2. And that kind of tells us here near term that we're continuing to rally, and we're going to try to either go for a C wave or for a 3rd wave advance, which should take prices in oil near the top of this channel towards $70 mark. As you can see in here, I have placed just a simple ABC for right now, just in case the market will hit the top of this channel, maybe create another X wave, and then will correct lower again. It's a thing that I have my doubts on because of this latest massive flush that we have in oil. I think we've kind of cleared that correction out of the way by completely flushing to zero, and we're starting a new a new move in oil, and it starts with moving to the upside. We will get corrections during this advance, but I think it's time to kind of start looking towards the upside rather than the downside in oil. Now, of course, you can always go sideways and create some kind of a huge triangle pattern in here, but that is not my preferred interpretation. I don't think that's going to happen in there. I placed an alternate wave 1 instead of a wave C in here, just in case this is going to end up being some kind of a wave 1. Again, that's a 2. You're going to get maybe a 3, a 4, and a 5, and you'll have wave 1 in oil complete, followed by a 3-wave decline back to near $30 or $40, and then you're going to start the new advance that's going to take the $150 mark, all-time highs from 2008. Near term, again, going from a 4-day to a 2-day chart, I'm looking at this progression as being a wave, again, just a wave 1 or wave A, pullback in B or 2, and at the minimum we should maybe we're not going to get full equality into the C wave because this was a pretty massive move in here, but I think we're going to reattack this $65 highs that were back in January of this year. So that's kind of what I'm seeing in the price of oil, and I remain kind of bullish on it. With everything that's going on with the reopening of the economy, with the reflation trade and so on, even though we might be getting some corrections in here short term, that could be just wave 1 of C like that. We're going to get a small pullback in here, but I think that's something that you want to buy, or even if you're coming all the way back to the channel here to retest this breakout, and that's going to be a second wave, maybe come back near $40 to $35 level in oil, and then we're going to embark back higher here, either in a C or a larger 3rd. So that's what I'm seeing in price of oil in terms of technicals. My next thing on the chart here is gold, and I've done pretty extensive video, I think about a week ago, regarding what I'm seeing into the long-term advancement on gold. You can kind of go check that out, but it kind of started back on a 3-month chart, talking about all this developments since the 30s, and where we are in the overall progression. 1 2 1 2, and then we're in the middle of this large cycle, third wave. So coming back to a 1-week chart in here, let me just kind of go back to a 2. So we consider the cycle wave 2 complete. That's a 1, that's a 2, and then we're in the middle of this larger intermediate third wave that's still in progress. This is a corrective move that should get completed here, if not already done, soon in here, and then we can start to enjoy maybe a rally above $2,000. These highs, 2080, I think it was the high in there, and then those are going to get taken out, complete this larger third, do a 4 and a 5th before we correct lower. So from a 2-week maybe to a 4-day, you can see how, and I might be wrong, let's say in some of these subdivisions, but the trend is clearly to the upside. This move is clearly corrective. It's nicely contained between parallel lines, which is what we want to see, and giving the look of this corrective pattern, we should make new highs above 2080 in here. So that's the trade here in the kind of shorter term trade, to try to maybe squeeze a 5th wave out of this larger third. We would get maybe another corrective move in here, another triangle, followed by another push to the upside. So overall, I think the gold market remains bid, and we continue to look higher on that. So that's what I'm seeing in gold. The next one on my chart is the 10-year yield on my list. So you can see in here, this is a monthly chart, but if I go, let's say, even if I go to a 3-month, and my data here comes from the 80s, but we've been in a big decline into yields, right? So we were over at almost 16% on the 10-year, and we've gone very, very close to the zero limit, so 0.30. So if you talk real yields, it's actually negative, but you're here now, and we've been enjoying a little bit of a rally since those lows. So we're approaching the 1% mark. In terms of the Elliott wave structure, it's a little bit hard to count all this. It's just just a total decline, as you can see in here, but you can take advantage of Elliott wave in some maybe shorter time frames. So going from a 3-month chart to a 2-week, you can see how we've had, ever since this correction kind of finished back here at about 325, there was an initial decline, which I can consider a wave 1, that's a wave 2, a sharp flush down in a larger third, and what we're thinking that's happening right now, it's a 4th wave, followed by one more decline below the lows, and then then a complete recovery. And this is where things are getting tricky with the 10-year yields, because if this happens, the market will more than likely have a pretty big crash. We'll go back towards everybody thinking, hey, everything is deflationary, where rates are going to zero, so on and so forth, and that will actually be the last flush that we're going to get. Now the risk here, or the positive, is that this is actually done, and this whole thing was just a completed move. The 3rd wave was somewhere up into this level. This was actually a 5th wave. This was a 4th. So you would do maybe a 1 2 3 4 5. So this is how this would look. Let me just kind of show it to you. Maybe this is the correct count. So 1 2 in here, 1 2 3 4, and this was your 5th, right? And if you look inside this 3rd wave, you can see how you have a 1 2 3 4 5. So 1 2 3, it's clean. It's not the shortest wave in the sequence. That's your 4th, and you flush down in 5, and this move down in yields is completely done, and we're not coming back near these levels for a long time. How we're kind of rising off these lows, it could be just a very simple wave 1 already. That kind of starts at these lows, and we're moving up in this. I'm trying to get my marker in here, so let me see if I get it. Yeah, that's a 1. So this is a simple wave 2 that already happened, ABC, and now we're in a 1 2, and we're in the middle of the larger third here, trying to attack this 1% mark before we pull back a little bit. But if you're thinking that if this interpretation is correct, and it looks very likely that it is, because this is a pretty large 4th wave, kind of compared with the second, so it starts to be a little bit disproportionate. So that's why I'm not favoring this. And then, the moment we're kind of getting near 140, this is going to start to become invalid. So the more we advance in here, the likelihood of this count being correct increases significantly. So I'll continue to kind of favor that and look at yields as bottomed, back near that 30 basis points mark, and then since then we're actually starting to look higher, and you can start to put a channel on here, something like that, and look for opportunities if the yields are coming lower in here and the bond market goes higher to sell the bonds, or enjoy the trade in however way you want and however you're thinking about the whole fundamental picture and the relationships with the other markets, right? But I would definitely pay attention to this, and I think that we've hit a major low in here, and now the yields are starting to kind of creep higher again. So look at this channel, look for opportunities if we're selling back off here to take advantage of that, and look at the new paradigm in here from the yields starting to creep up higher. Right, so that's my analysis on the 10-year. Let's go and take a look at the S&P 500. So the S&P 500 in here, I'm not gonna look at the very long time frame. This is a 2-week chart. We're basically looking at a continuous impulsive move in here, and the discussion in here is this going to be a fifth wave followed by a pretty deep correction back near the fourth wave of a lesser degree, or we're actually in the middle of a larger third wave that continues to push. So I have a little bit of a different subdivision in here, so you can see I'm considering this maybe a fourth wave, right, of this kind of super cycle degree, and then this is we're near terminating the super cycle move into the stock market. If you think of this in nominal terms or real terms, whatever, if you price this in dollar or in something else, things are definitely changing. You're thinking, inflation in the assets and all that. But I'm trying to kind of, give you a little bit of a perspective in terms of the structure of how the markets look and how we're counting the waves in here. So if we're thinking that this is a fifth wave and that's a 1, that's a flat in 2, then you go in a 1, 2, 3, 4, and 5. We completed a larger third wave cycle. This was another flat in wave 4. That means that, we are in the, in the ending stages of this fifth wave, which should lead to a pretty heavy sell-off into the stock market. We're going to reach a top somewhere near 3,800, between 38 and 4,000 for a fifth wave, and then roll back down. Right now, this topping pattern will be pretty aggressive. So we'll see if the markets are going to do something like you're going to get a head and shoulders. So this is going to be your initial decline of the highs, then you're going to go back in here, and then that will be your right shoulder, and then you're going to sell back off, and you're going to have a pretty massive correction that's going to send you back to 800 into the S&P 500. Pretty hard to believe that, if you look at how the dollar is going, right? So what's going to trigger to overall in the world for the S&P 500 to decline in such an aggressive way. So I got my doubts about it, but if this is a fifth wave, again, near term, I'm looking at this thing as continuing to push towards 38 to 4,000. You can see I have a 5v1 relationship in here. So 100% of this fifth wave compared with this wave 1 comes in at about 39.58. So at the minimum, those are some of the targets I look at. And then the other one, it's distance traveled between wave 1 and wave 3. Compared with this fifth wave comes at about 38.35. So these are some near-term targets, and then we'll see what happens from there. If I go on a smaller time frame, so if I go from a 2-week to a 4-day chart, this is an advancement of the low in a 1, 2, larger 3, 4, and we're trying to finish this fifth wave. So going even to a 2-day chart, you can see kind of how that looks. And if we're ending this, then somewhere up here, we're going to encounter a large resistance, and then the market should respond. The risk is that this is not a fourth wave, and it's actually a 2. So you're actually maybe doing an extended fifth wave, and you're moving much, much higher into the equities, and that's always a risk. And this whole thing, it's actually a second wave. We're completed a wave 1 up into these levels. That's a 2. And we're actually in a wave 1 of a larger third wave advance. So that would be a 1, maybe do a little bit of a resistance up somewhere up into these levels, do a pullback. If this happens in 3 waves, that's an opportunity to buy the stock market for a larger advance. So I think overall it's really important what's going on up into these levels and how the markets are going to react from there. But near term, I continue to remain bullish. And then this one, it's a little bit different, just because I'm changing the placement of this wave 1. So in the other count, this wave 1 was here, and you can watch the fib on the 5th wave, how it moves based on what I placed this wave 1, because that's a fib projection. So if I leave it in here, we're going to be near the targets that I've showed you before. If I place the wave 1 in here, and the reason I do that, it's because of the guideline of alternation. I have a couple of flats in here in this 4th wave, and I really don't like that. I would like the 2nd wave to be more of a directional zigzag, and this is more of a flat. So we're alternating in here. But at the moment we do that, we're screwing a little bit with this 3rd wave. So I gotta find a 2nd wave in here, right? 1, 2, 3, 4, 5, maybe 1, 2, 3, 4, and that's a 5th. So it works. It's a matter of how you play with the subdivisions. Either way, you're looking at about 38.20 on a 5v1 plus 3, but you're looking much higher for an equality 1 plus 5, 1 to 5, and that comes at about 4,400. So let's just call it that anywhere between 3,800, I know it's a pretty large range, and 4,400, there's still a lot of room to go into the S&P 500, and that can take you another couple of years, or of impulsive price action before you're actually hitting some kind of a top and you're starting to do a correction. And usually corrections come back to 4th wave of a lesser degree, and that would be somewhere back into these levels, right? So that would be a pretty big crash. Again, the risk is that this continues to push higher, and this is not a 4th, but rather a 2, and the market actually explodes much, much higher in the next 10 years, right? But that's how we're kind of going at reading Elliott wave one step at a time. We look at the structures and try to position yourself, on a smaller time frames based on what you see on the counts, and try to take advantage of those moves. If you're a longer-term investor, some of these things don't really matter, but even then, I think, having a view of where you are in the overall cycle, I think it's important. So let me finish off here with the DXY. And, I've talked about it, I think, in a smaller video I've made a few days ago. I think it must have been in our pro room. But let's take a look at it. So this is a weekly chart, but let me take you over to a 3-month. And what I have in here, right, I have the data kind of going back to the 80s. So we've been in a pretty much, dollar bull scenario since 2008, right? So at the end of when we started the Great Recession, we've had this kind of huge rise in dollar, and then we corrected lower in here, we've done an impulse, and now we're coming back here, we sold off, corrected, and then come back again. So there's a couple of ways you can look at this, and both of them are valid, and we're going to find out which one is going to pan out, I think, pretty soon. So one of them is that we're actually in a bull market in the dollar that started back in 2008, and this is, let's say, a wave 1 of the lows, and this is your ABC down for a wave 2. This whole thing here was a 3rd wave, 1, 2, 3, 4, 5. So we're measuring that as 3rd, and now we're doing a 4th wave pullback. As long as we're remaining on the closing basis, and so what I'm trying to say, wave 4 can never close in the territory of the wave 1, right? And I don't think this wave in here, even if it penetrated it, this 4th wave is not complete. So there is a chance that as long as we're not closing an ABC correction in here below this red line that I have, this could be a 4th wave, and we're actually doing a 5th wave advance into the dollar, right? So this is kind of more of a longer term perspective. This would happen once we're coming back here, touching the trend line, we're turning, and we're making a massive advance into the dollar. Here is the other count. The other count is that so staying with this near term, I still think we're going to try to push lower, right? We're going to try to get some kind of an equality between the waves. So you're going to get this wave in here with the one that we've had. You correct it up higher, and now if we're doing 100% of this decline, you're going to come back here towards 84, 85, somewhere in that range. Into the dollar index before you can get a little bit of a bounce. So if that's going to be, if we're going to get below those levels, then I think I'm going to have issues with this being a fourth wave. So I'm either going to have to consider this a 1, and this is going to be a 2, and not a 4, and then you're kind of going back up higher, right? That's the only way where I can stay and accept this corrective move as being an ABC and then a rise up here into the dollar. So I think it's very important what's going to happen at those levels. If we're going bearish on the dollar and we're actually trying to, take these lows even, right, then I got to look at this whole thing as being a corrective move. And I'm going to find that out the moment the dollar starts to break below this trend line and continue to push lower. That's going to become a 1, that's going to become a 2, and then this is going to become a 3. We're in the middle of this larger 3rd, 4, and 5, and come back towards 70 mark into the dollar index. And the way I would look at that as a corrective move, it would be that this is a very simple, A in here, and then you do your B, and then this is your C wave, right? So you have an A, you have a B, and then you have a C, or you can do maybe a W, you can do a triangle in X, and then you can do a Y. And this whole thing is a corrective move that follows a decline that, that started back in 2000. So this is an impulse, right? So you have your A, you have your B, and then you're doing your C down into the dollar. So very important, because you can count this move depending on the, how you're looking at the time frame. You can count this as corrective or the beginning of a new impulse. So near term is very important what's going to happen once we're attacking this trend line. And I think this is kind of where we're going. If I go now from a 3-month maybe to a 1 month, and let me just go to a couple of weeks, so you can see how the rejection happened up here at about 88% of this whole decline. This is a nice clean impulsive move, right? You have your 1, 2, 3, 4, and 5. Then you correct up higher here in gold, maybe just a simple A, B, C in here, right? Just an A, B flat, and then up in C. And then since then we're declining. So if I'm looking for this equality, I still got to get again near this, maybe 88. I think we're going to take these lows and, get maybe towards even, 86 and a half, 87 mark. So that would be your equality. If we're continuing to push to this trend line, then this become a larger third wave. So it's very important what happens here and how we push back. There might be a corrective move happening because we could already have, an impulse that's getting complete near here, so we can get an ABC. And if this is all we're seeing, and then we're attacking the trend line again, then we have more confirmation that a larger decline into the dollar starts. So near term, pay attention. I think we're going to continue to be weak and take these lows from 2018, and then get a little bit of a bounce here, and then we'll decide, depending on this corrective move that we're going to get from here. It's going to be a little bit of a dollar strength. Then we'll find out if the dollar is really embarking into the weaker phase, or it's continuing up higher here, right, to a 1, 2, and then push. So there'll be some decisions that are going to happen next year in the dollar trend overall. All right, so I'll leave it at that, guys, and thank you for watching. Maybe I went in too much detail. Let me know in your comments what else you want me to cover. If it's too much information, if you want me to keep it a little bit simpler, that's fine. If you want to learn more about Elliott Wave, visit us into the pro room. There's also a public free channel where there's guys posting charts, and we're learning Elliott Wave. When I'm correcting, I'm trying to, get as much information to make sure that the counts are correct. But, if you want to stay on top of these things every single day, I do daily videos in our pro room, and we talk about crypto. We look at this, macro as well almost every day, and we follow the markets. We trade across this whole spectrum, and we try to take advantage and positions ourselves based on some of these technicals into the stocks and gold and oil and cryptos. So thanks again for watching. Hit the thumbs up button and subscribe so we can rise in the content. And if I don't see you in the room or in the public channel on Telegram, I'll see you in a couple of weeks for another macro update. Talk to you soon. Bye bye.